Hello, students. This is Accounting 442, Chapter 3. Let me share my screen. Okay. All right. The tax formula and tax determination. So, the chapter objectives. Apply and identify the federal income tax formula. What are all the standard deductions? There's standard deductions and there's additional standard deductions. And what choice are you going to make to be able to get your taxable income? The current status of the exemption deductions and rules for whether someone is dependent or not. What's your proper filing status? Proper procedures for your tax liability? What if you have unearned income of a dependent child or the kid? Do you have to do the kiddie tax formula? So the big picture talks about you pretend that this is somebody sitting across the table from you and they're your client, right? So Aaliyah has a household in which she lives with her unemployed husband, Trevor, her stepdaughter, Paige, her family friend, Tara. She provides more than half of the support for both Paige and Tara. Tara, her friend, was fatally injured in an automobile accident in February. Aaliyah paid for the hospitalization and funeral expenses. Paige, her stepdaughter, is an accomplished gymnast, and she graduated from high school last year. All of these things are important to remember. She graduated from high school last year. She has a part-time job, but spends most of her time training and looking for a scholarship to the right college. We don't know her age. We don't know if she's, so there's different things about the big picture that when we get to the sections, it'll show that it's important for you to know. So you've already read the book, so you should be reading the book before watching this video. So you should kind of have an understanding. In March, so January, February, March, 3 months out of the year, he was living there. Trevor left for parts unknown and has not been seen or heard from since. Aaliyah was more surprised than distressed over Trevor's departure. One reaction was that she was going to sell her wedding rings to a cousin who was getting married. The rings cost her $11,800 and she sold them for $9,000. So that's $2,800 of a quote unquote loss that she has there. Is that loss allowed to be taken? So what's the tax concerns? So what's the tax formula? So each of these categories, exclusions, are in Chapter 5. Income, Chapter 3 and 4. Gross income. So they're broken out between chapter, right? It's the tax formula for individuals, but it's kind of not as clear as what I think it should be. I think they need to update this because the form doesn't work that way. And when you're doing tax returns, you have to make sure that you're putting things on the form correctly. So your W-2 here is where you have your income from your job, other types of wages or tip income, any kind of payments. And then you've got these other earned income. You've got your tax exempt interest. So interest that you earn, but it's tax exempt. Qualified dividends. So A, none of these are added up in this line, but you still have to report it, but you're just not going to be taxed on it. This is taxable interest income, ordinary dividends with income. These things are income. Then you have additional income from Schedule 1. So you need to look at these different schedules, right? Because on the Schedule 1, we have the first page are other types of income that you add. And the second page are adjustments to income, which are mostly expenses, which are deductions or IRA deductions. So your exclusions are kind of mixed in. It's like your income minus your exclusions is your gross income, minus your deductions for gross income. But the way the form works is that on page 1, mixed into the Schedule 1 has income and deductions. And then the other schedule, adjustments to income, Schedule 1, are, so it's, and then you get to your adjusted gross income. So there's, in these different schedules, let's go back to Schedule 1. For income, you go to Schedule C. Now, Schedule C has income and expenses, right? So when we go to our form over here under Schedule 1, there's income and expenses in this line, income and expenses in each of the lines. So it's a little bit more detailed than what this says, but the idea is that you've got income and deductions, and then you get your standardized and or itemized deduction, which is on this line right here. You're either going to do a Schedule A itemized deduction, or you're going to pick one of these standard deductions right here. And we'll get into the details there. Now, after those itemized deductions, which reduce your income, there's personal and dependency exemptions that used to be on a tax return, and deductions for personal and dependency exemptions used to be on the tax return, but they're no longer there. From 2018 to 25, they were taken away. But the deduction for the qualified business income was added, and it's going to be allowed and applies from 2018 to 2025. Then you get down to your taxable income, then your taxes and your tax refund that's due. So income is all income that you have earned, taxable and non-taxable. So again, on page 1, if I have municipal bond interest of $600 and I have a qualified dividend of $200 and I have an IRA distribution of $100 and I have a pension of $1,000 and I have Social Security benefits, which can be either 0%, it could be the whole amount is over here, or 0 could be 15% could be here, or 85 could be there. So we're going to get through what part of qualified dividends is not taxable and ordinary dividends that is taxable. IRA distribution part that could be taxable if you pulled out your IRA distribution too early. Social Security benefits. So let's say this is $500. So this is all income that I received, but it's not included in the total income line. You don't, this is just 2B. I might have $200 of taxable interest. I might have $500 of ordinary income. I might have a taxable amount of something else, let's say $600. And then my Social Security benefits, I might have taxable of $700. So this line here, total income, is asking you to add line 1Z, which adds up all of these, plus just the 200, the 500, the 600, the 700. So it says here, income is both taxable and non-taxable. You have to record it. The non-taxable stuff is like reporting it, but it's not going to be added to this line, which would then become part of your taxable income. Okay. The IRS, the Internal Revenue Code, says income is everything except as otherwise provided. So unless it says this is not taxable, then it's taxable. So what they're saying is the IRS doesn't know about every single type of income that's out there. However, there are some types of income that is not taxable. So if you don't know if it's taxable or not, you look in the IRS code. And if that type of income is not written anywhere to say this is not taxable, then you need to put it in and assume that it is taxable. Okay, and it's going to be included as taxable. Gross income does not include unrealized gains. What's unrealized gains? Let's say I buy a stock today for $10, okay? And 4 years from now, I still own the stock, but it's not worth $10. It's on the market for $50. So I bought it for 10, and now the value of it is 50. So I have an unrealized gain of $40. Why is it unrealized? It's unrealized because I haven't sold it yet. So the value of your stock that has gone up, but I haven't sold it yet, it's called unrealized gain, which means you realize it once you sell it. So here are some examples of exclusions from gross income. If I get into an accident and I get insurance proceeds, I don't include, that's excluded from gross income. You don't list it out. Alimony for divorces after 2018. So if I got divorced in 2017 and I received alimony, that's going to be included. Now, if I got divorced in 2017 and now it's 2024 and I received that alimony, is that alimony going to be included in my gross income? Yes, because my divorce happened in 2017. So all my alimony, because I was divorced beforehand, my alimony will be included in my gross income until I stop receiving alimony. Because my divorce was before 2018. If I got married, if I got divorced after 2018, none of my alimony is included in income. Child support payments are not included in income. Cost of living for military, damages for personal injury, gifts received is not included in my gross income. Inheritances, interest from municipal bonds. That's what I had over here, right? That's tax exempt interest. And you can read some other ones, right? These are partial lists of gross income items. Divorces before 2019, I'm going to include that alimony because I got divorced before that. Awards, back pay, clergy fees, compensation for services, death benefits, debts forgiven, hobby income, jury duty fees. And you can read more of those. And there's some more of these here. So when we talk about deductions for AGI and deductions from AGI, when I'm on my tax return here, line 11 is my AGI, my adjusted gross income. So when they talk about deductions for AGI, it means everything above the line. So on my Schedule 1, any type of deductions that I have for my Schedule 1, any type of deductions I have on my Schedule C, anything on my schedule, if I go to my Schedule 1, I've got my Schedule E, I've got my Schedule F, I've got all these different schedules, and all of these information have income. Schedule C has income and expenses. Schedule E has income and expenses. Schedule F has income and expenses. So those are deductions, right? So deductions for AGI are everything above the line for AGI to get. So I'm calculating this for my AGI number. Okay. Deductions from AGI, you're deducting from. If I have 10 apples and I take 5 away, I'm taking 5 from the 10, right? So it's after. It's from AGI. So if I've got my AGI here of $100,000, my itemized deduction and my qualified business, those are the only 2 deductions from AGI. So the for AGI is got a lot of deductions on the different forms. So it's you can't actually write all of them out because there's so many different deductions depending on what form you might use. And there's thousands of IRS forms. So anything above the line is for AGI, a deduction for me to get to my AGI, and anything below, which is just your itemized or standard deduction, and your qualified business deduction is from AGI to get you down to your taxable income. Again, for AGI or above the line. They're taken before the line designated AGI. Okay. There's a whole bunch of them. Trader, business, schedule, and I went through some of the forms for you. Deductions for AGI, interest and student loans, excess capital. So if you went on, I want you to look at your Form 1040. I want you to look at your Schedule 1. I want you to look at the Schedule 1. And when you go to the Schedule 1, I want you to look at Schedule C. I want you to look at Schedule E, Schedule F, Form 20. I want you to look at all these different forms so that you know what this is all about. Right here is your jury duty pay that you have to add as additional income. Down here, your educator expenses. Like I'm a teacher. If I spend money on buying stuff for students, that is an educator expense. Our IRA deduction, your student loan interest deduction is right here. Jury duty pay deductions. Some of them you have a deduction. So these are all the different types of deductions that are for AGI because they're above the line. Again, from AGI are just either your standard deduction or your itemized deduction. And your itemized deduction is your Schedule A. Excuse me. Excuse me. Schedule A has a few categories. Medical and dental expenses, which are limited to 7.5% of your AGI. Taxes that you've paid throughout the year, which is limited to $10,000. Interest, some certain interest that you pay can only be home or mortgage interest. That's it. Some gifts to charity, which they must be made to the benefit of an organization that the IRS approves. Certain casualty and theft, and some other deductions. You add all of those up. Let's say this amount, I'm single and my total deductions is $50,000. I come back to this line. I'm single. So on this line, I'm either going to pick single $13,850 as a deduction. And let's just, I'm going to say zero for this right now. So 13,850 from 100,000. I don't have my calculator up with me. I'm not good with math. Is 86,150. 86,150. That would be my taxable income. But my Schedule A is telling me I have itemized deductions of 50,000. And that was, I just made this number up, like that I added stuff up. Let's say this is 10,000. This is 40,000. And this is 10,000. Add it all up is my 50,000. So what would you rather have? A deduction for 13,850, which gets you to 86? Or would you want it to be 50,000 that gets your taxable income to be 50,000? And then you're going to get paid tax on 50,000, which we did in chapter 1, which was all the different tax rates. Okay. And these are the listing of the types of deductions, which we'll get to later on. Deductions from AGI. These are employee business expenses. These used to be on this line here, this other itemized deductions. So I'm going to pull up Schedule A from 2013. Okay. If you look down on this form, there's all of these other types of expenses here. And there's, you still had your medical, which was calculated differently. There was a 10% limit, then a 7.5% limit, because the tax laws changes. Taxes that you paid, interest that you paid, gifts to charity, that's all the same. But this category here, job expenses and certain miscellaneous deductions, is no longer there, right? Because it's gone. So it was taken away between 2018 and 2025. So, but they might come back in 2025. It depends on who becomes the president and of the United States, and then whatever tax laws that they want to change, because this was changed by a president. Okay, so this is about the tax formula for the correlation of the 1040, but I just showed you all that. So, which of the following is a deduction from AGI? Excess capital losses, which would be on your Schedule D, capital gains and losses. Contributions to a health savings account, which that would be on your Schedule 1. So if you look at these forms, you'll know. Interest on student loans is your Schedule 1. Medical expenses, which is on your Schedule A. And now Schedule A is from AGI minus standard or itemized. So it's from, so your answer is going to be medical expenses. Now, the standard deduction. The government gives you this deduction. If you're single or married filing separately, it's $13,850, which is that line right there, the $13,850, which got me down to $86,150. Now that $13,850, because you add these two lines together. Now, this qualified business income deduction we're going to do later on in the semester. It's a huge, big calculation, but we're just going to ignore it for right now, okay? So the standard deduction is basically the IRS saying, we're going to give you a deduction for, your living expenses. Like we're not going to pay for your living expenses. We're not going to pay for everything, but we're just going to give you a little bit of a tax break to reduce your gross income by the standard or itemized deduction. Married filing jointly is the $13,850 times, I think it's $13,850 times 2. It usually is. $27,700, right? $27,700. Head of household it's like a single person, but they qualify as they've got dependents and they're the head of household. So that's the question. Is Aaliyah a head of household? Because then she'll get a larger deduction than the single, right? $13,850 versus $20,800. And there's a couple of other standard deductions as well. So that's the basic standard deduction that is there for you for every single person, the basic standard deduction. There's also an additional standard deduction, okay? Additional. So there's the basic, which is the ones that we just saw over here. And then there's the additional standard of $1,550 or $1,950. Now, the $1,550 and $1,950 are there for a taxpayer who's over 65 and blind. Okay, so this form here is the 2023 tax form. They don't have the 2024 tax form out yet, but they've already passed the law of what the standard deduction is. So I'm using the 2024 numbers here. The 2024 single standard deduction is going to be $14,600. Let's say I'm over 65. I get an extra deduction of $1,950. If I'm also blind, I get extra $1,950, which is added all up. My standard deduction on the form is going to be this $18,000 right there, $18,500. That's what that's talking about. Now, well, what's the $1,550? What's the $1,550? Well, the way that it works is if you're married filing jointly and you're over 65, you get $1,550. You don't get $1,950. If you're married filing jointly and you're blind, you get 1550, not the 1950. Okay, so if you're over 65 and blind, you get the 1950 twice. If you're single, so let's go to this form here, right? So here is the basic standard deduction. If you're single, in 2023, it was 13,850, which is what the form tells you, 13,850. And for 2024 is 14,600. For married filing jointly, 29,200, head of household, 21, and 14,600. The married filing separately and the single are usually the same number. The married filing jointly, surviving spouse are usually double the single. A surviving spouse is, I was married and my spouse passed away. So the IRS gives you 2 years of being a surviving spouse, because it usually takes about 2 years for an estate to be settled. So you get this deduction of as if you were married, even though your spouse has passed away, for 2 years. And that's usually the double. And head of household is just like a little bit more than the single. So let's go to that additional one, right? So if I'm single and I'm older than 65, I get 1950 as a deduction. If I'm single and over 65 and legally blind, I get 1950 twice, which is what I'm showing you here. I get 1950 for being over 65, and I get 1950 for being blind. So let me put this over here, and let's say that I am married, filing jointly. I'm over 65 and I am blind. What is my amount that I get? Pause this, fill this out, and then come back to it. I'm not going to pause it, but you're going to pause this now. Fill this in by using your form here and your form here, and then come back to it. All right. All right. So welcome back. So married filing jointly is 29,200. Over 65, married filing jointly is 1,550. Same thing for here. So equals 32,300. So my standard deduction is, what happened to my underline? My underline went away. It's 32,300. Okay? So that's how that works. Who's not eligible for the standard deduction? You're not allowed to use the standard deduction if you're doing your tax return if you're a married individual filing a separate return where either spouse itemizes. So if I'm married and my spouse and I decide that we're going to file separately, doesn't mean we're separated, it just means we're going to file 2 separate returns. And sometimes what happens is a lot of married people, they'll go to their accountant, and the accountant will do it both ways. They'll do it filing separately and they'll do it filing jointly to see which is the best outcome. So if they file separately and one of them itemizes, the other one cannot take the standard deduction because it's like doubling up. Because usually when you're itemizing, there's a lot more there, right? There's the 50,000 that I came up with, what form is, right? The 50,000. So you're not really allowed to double dip. Okay, so you can't use the standard deduction because one of them is itemizing, so you can't take it. You put 0 on that line. What if you're an individual who's neither a U.S. citizen or a U.S. resident? You cannot use the standard deduction. You just put 0 there. Okay, now there's a limitation if you have a dependent, which we're going to talk about what a dependent is after this. So if you have a dependent, meaning, let's say I have a child and I'm filing my tax return and I'm listing them on page 1 of my tax return as a dependent. Child number 1. You have to have a social security number. I'm going to say it's my child and see if I get the credit or whatever, doesn't really matter. But if they're a dependent of mine, then I'm claiming them on my tax return. Okay. Now, the challenge with this is that I said earlier, on that page. Oh, I don't know where that page is now. I said that there was exemptions for, where'd it go? I don't know where it went. I lost it. There was an exemption. So having someone as a dependent, there's also a personal exemption, which is gone right now. But when the child or dependent files their own tax return, they have a limit of having the individual claimed as a dependent has a basic standard deduction in 2024 that's limited to the greater of $1,300 or $450 plus earned income, but not to exceed the basic standard deduction. Now, the basic standard deduction for a single person is $14,600. So the rule here is 1,300 or the greater of 1,300 or 450 plus earned income. So the greater of 1,300 or 450 plus earned income. So down here, what's earned income? Earned income is your wages, business income, things that you actually have to do something to earn it. Interest income, dividends, etc., like that, that's called non-earned income. So which is greater? I've got $900 of wages. So the $1,300 is here. $1,300 is the standard deduction, $1,300. I'm going to compare that to my earned income plus 450, right? 450 plus earned income. That's right here. A29 plus that is 1,350. So that's 450 plus the earned income. So what's the standard deduction? The standard deduction is 1,350. It's the greater of 1,300 or 450 plus my earned income. My 450 plus my earned income is 1,350. So my standard deduction is going to be 1,350. Okay? Here's another example. My wages are $1,000. Right? $1,000. What is greater? 1,300 or 1,000 plus 450? Right? Because it's the $1,000. That's the earned income. It's 450 plus the earned income. So 450 plus the earned income is 1,450. So my 1,450 is greater, which is over here, your 1,450. So Dover, age 15, is claimed as a dependent by a grandparent. During 2024, Donover had interest income from Google Corp bonds of $1,000. We don't care about that because that's non-earned income. And earnings from a part-time job of $700. So 700 plus 450 is 7, 8, 9, 10, 1150. His taxable income is what? So the 1,000 and the 700 is 1,700 minus the standard deduction. What's the standard deduction? 400, right? So the standard deduction is the greater of 13 or 1150, which is the 700 plus the 450, right? So what's greater, 1,300 or 1150? 1,300. He made 1,700. 17 minus 1,300 is 400. So the answer is D, 400, right? So let's do that again. He has earned income of $1,000 and 700 from a part-time job. So that's the revenue, $1,700. Right? $1,700. And then you have to do, right? So that $1,700 would go right here. Sorry, the $700 would go here and the interest would go here. 1,700, right? So his income is the 1,700. Take all these things away. Make this 1,700. So we're trying to figure out what the standard deduction is. The standard deduction is going to be the greater of 1,300 or earned income plus 450. So his earned income is 700. 700 plus 450 is 1,150. Which number is greater, 1,300 or 1,150? The 1,300. So he gets to deduct 1,300. 1,700 minus 1,300 is 400. Okay. Exemptions. Oh, this is where it was. Okay. Personal exemptions and dependency exemptions. So it used to be I would get another deduction for each dependent that I had, a personal dependency exemption. All of that went away. Deductions are suspended for exemptions from 2018 to 2025. So the personal exemption, I would get on top of my standard deduction or my itemized deduction, I'd also get a personal exemption for myself, a little bit more money of a credit to reduce my income. And I would also get an exemption, which would be reducing my income for each child or dependent that I had. But again, they're gone. Okay. Now, on this page here, I can have a dependent that does not qualify for the child tax credit or does not qualify for a credit for other dependents. Which we're going to get to in the rest of this chapter. So I can have a child here that's not going to give me a child tax credit and it's not going to qualify for a credit for other dependents. Now, if I do have a qualifying child or a qualifying relative, there is an exemption amount of $5,050. Just if because I can have a dependent that's not a qualifying child or not a qualifying relative. But now they gave this rule saying that if they are a qualifying child or a qualifying relative, you can have an exemption of 50-50. Okay, and that's the amount there. So dependents. We have two types of dependents, a qualifying child and a qualifying relative. Now, with the qualifying child, there's these tests. The qualifying child, once somebody's a qualifying child, the definition for that will go to other tax provisions in the IRS code for head of household, earned income credit, child tax credit, credit for dependent and child care. So what makes this child qualify for the child tax credit? And if they don't qualify for the child tax credit, can they qualify for a credit of other dependents? Okay, it's very tricky, but we're going to look at all of this here. So if I make this smaller, you'll see this, okay? The qualifying child has these tests. The qualifying relative has these tests. Okay, qualifying child, qualifying relative or other dependent. Relative or other dependent. So there's a relationship test in both, but they're different. The relationship test for a qualifying child is different to the relationship test for a qualifying relative. The residency test is only for a qualifying child. There is no residence test for a qualifying relative. There's an age test, but not here. There's a support test for both, but the support test is different for both. So let's say I have a child and they are dependent. They may also qualify for these other things, which is this slide that I said right here. Okay, same thing. I copied it over. So these slides here, I put over into the Excel file because it looks easier on one page. Okay, but you can read, you should have read the book, right? What is a child must be one of these things, right? Okay, so to be a qualifying child, this is the relationship test, the residence test, the age test, the support test. I'll move this over so you can see it. The qualifying relative, this is the relationship test, not the same, the gross income test, and the support test. Not the same. So we're going to go through this. I might have a child and they meet the relationship test. They meet the residency test. They meet the support test, but they don't meet the age test. If they don't meet all the tests, then they're not a qualifying child. But if that child meets the qualifying relative tests, they would be a dependent. Okay, so a qualifying child must meet all of these tests. If they don't meet these tests, I can look to see if they are a qualifying relative or other dependent. And they're basically just saying, because the child tax credit is greater than the credit for other dependents. And this is just the law. This is just the laws, okay? So to be a qualifying child, it's going to be anybody that's a descendant of you or equal to you, like sisters, stepbrother, stepsisters, sister, half-sisters. They're on the same line as you, or someone below you, a son or daughter or child, foster child, okay, or a descendant, a grandchild, a nephew, or a niece. Anybody that's below is a qualifying child. That's the relationship type: son or daughter, adopted child, stepchild, foster child, brother, sister, blah, blah. On the qualifying relative, it's anybody. It could be anyone. It could be aunt, uncle, grandma, grandpa. It's even members of the household who they're not even related to. So if we go back to the facts, unemployed husband, stepdaughter, and family friend. Is page 19? We don't know. We'd have to go back and ask. Tara, she lived there till February. Did she live there all of the year? Well, technically, yes, because she died in February, so she lived there in all of her year, right? So does Paige qualify as a child to get the higher credit, or does she qualify as a dependent, or neither? Does the family friend who would be underneath this section here, members of the household that live with the taxpayer the entire year, or her entire year, because she died in February, she could be a qualifying relative or other dependent if she meets the gross income test and the support test. Okay, so Does Paige qualify as a child? Maybe she doesn't because she's over 19, or maybe she makes too much money, but she still might qualify as a dependent. And the family friend Tara may qualify as an other. She can't qualify as a child because she's not going to meet the relationship test, right? Son or daughter. She might meet the residency test. We don't know if she's meeting the age test and support tests. Okay, that's how this is how this works. And the idea is, why do we care? Because if they are a child dependent, they can get the tax credit, which gives them another deduction on their tax return. If they're another dependent, they get the credit to reduce their taxes on their tax return. The resident test: the child must live with a taxpayer for more than half the year. And that does not include if they're out in college, right? That they come home they still live at home. They don't have another place, right? They might be living in college, but they come home. Must be under age 19, which means 18 and below, or under 24 and a full-time student. So it has to be 23 and below. The support test: the individual must not be self-supporting. They must rely on the money that Aaliyah gives them, right? Cannot provide more than one half of his or own support. Let me just move this down. Okay. In the case of a child who's a full-time student, scholarships are not considered to be support. So if they're going to college and they got a full ride, that's not support, right? It's just paying for their school. Okay. So is Paige a qualifying child? Yes, let's see if she's does she meet the relationship test? Yes, she's a stepchild, right? Because she's a stepchild, stepdaughter. So she meets the relationship test. Yes, good. Residency test: does she live there for more than half the year? Do we know that? She graduated from high school last year, has a part-time job. We don't know where she lives. We have to ask that question. So we don't know if she lives there more than half the year. We don't know if she's under 19. So we can't move further. We have to go back and ask Aaliyah, has she lived there more than half the year? Is she under 19? And then does she, based on this, has a part-time job that spends most of her time training and looking for athletic scholarship? That part-time job might be able to pay for her and make her be self-supporting. Who knows? So you don't have all the information to know about Paige. So we need to get that information first. What about Aaliyah, the family friend? Does she qualify for a qualifying child? No, because she's a family friend. She has to be a child to be a qualifying child. So let's move to the next one. So we don't know about Paige yet. We'll come back to her. Qualifying relative, relationship test, not the same. Aaliyah, Tara is a member of the household, a person who lived there for her entire year. So she meets the relationship test. The gross income test: she was fatally injured in an automobile accident in February. We don't know if, Paige and Tara. Oh, let's go back to this here. I forgot. Aaliyah provides more than half of the support for both Paige and Tara. So it looks like the support test works for Paige. So we just need to know about the residency test and the age test. So for Tara, she meets the relationship test. Cool. The gross income test. The dependent's gross income must be less than the exemption amount, that 50/50 or 4,700. What does that mean? There's an exemption. A dependent's exemption is 50/50. So their gross income must be less than that. So in two examples, if my gross income is 6,000, not a dependent makes too much. So when we're looking at this gross income test, if they make more money than the 50-50, they're not a dependent. They fail this gross income test. They're not a dependent. The gross income is 4,200. It's less than. They can be dependent if the support test is met and the relationship test is met. We don't know how much Aaliyah or Paige made. We have to find out. Or sorry, Tara and Paige made. Support test. Furnish over half. Yep, they met this test. Okay, so we don't know how much Tara made. We need to find this out. But Tara does meet this test of members of the household, and she meets the support test. Now, for Paige, we don't know how much money she made, right? So let's say Paige is over 19. She will not be a qualifying child. However, she is her child, but she won't be considered a qualified child. Does she meet the qualifying relative? Yes, she does. Does she meet the gross income? We don't know. We have to find out. But let's say she does because she's 4,200. Okay, great. We do know she does meet this test. So Paige, even though she's her child, she doesn't qualify for the rules of a child because of her age and maybe because of her age, let's say, we're making this up, we don't know. But she does qualify if we make up the number that she makes 4,200 for these three, so she'd be considered a qualifying relative. So we put over here, she's a qualifying relative, and then she'd be eligible for receiving the credit. Okay, so a child tax credit is $2,000 for each child. Now, we've said, let's pretend that Paige does qualify as a child. The age test to be qualified as a child is under 19, but let's say she's 18. Just because she is a qualifying child doesn't mean that she's going to qualify for the actual credit. Because if she's under 19, she could be 18. But to get the tax credit, you have to be under 17. So she doesn't get the child tax credit because she's 18, she's too old. But she can get the dependent or the other dependent credit of $500 because it's for people over 16. Members of the household, parents, children about 6, right? So she can be a qualifying child. This age test here is under 19, but the tax credit is for anyone under 17. So she can be a qualifying child, but not be able to get the 2,000 because of that 17. Okay. That's the only thing that, to me, doesn't make any sense. Why are you saying they were a qualifying child, but they could be 18 but not get the actual credit? So it makes them then be an actual dependent. Okay. So just going through, if you look through the book and read the book, which you should have read already, does Paige meet the requirements of a qualifying child to Aaliyah? Well, she satisfies the relationship test and the residence test, but we don't know her age. So if she's under 19, then she'd be okay, right? The support test we went through, there are some tiebreakers. Let's say there is a situation where a child may be a qualifying child to more than one person, right? They might be divorced. The person eligible to claim the qualifying child as a dependent, who will prevail? Let's say one of the persons is the parent. The parent will get the deduction, the credit for claiming the child on their tax return. What if both persons are the parents and the child lives with one parent? The parent with a longer period of residence will prevail. Both persons are parents and the child lives with them the same amount of time. The parent with a higher gross income, AGI, will get the qualification. None of the parents is the person with the highest AGI. Okay, so that's how they do the tiebreaker. Okay, qualifying relative, we already went through this, and then there's the relationship test. So although Tara is unrelated to Leah, she qualifies as dependent by being a member of the household. Because Tara is a dependent, she can also claim the medical expenses that she paid. Funeral expenses are not deductible. So when she says that, we're talking about Schedule A. Over here, whatever expenses she paid, any medical expenses she paid for Tara, she can deduct here as well. That's what that's talking about. Funeral expenses are actually deducted on the estate of Tara. That's where they are. Qualifying relative, the gross income test is 50-50. The dependency exemption, we already went through all this. The support test for qualifying multiple support, you can read that. Children of divorced or separated parents, there's special rules, you can read those. Another thing to look at is other rules for determining dependence. In addition to fitting into either the qualifying child or the qualifying relative or other dependent, a dependent must also meet the joint return test and the citizenship test. The joint return test is if I have a dependent, let's say I have Paige, and she's my dependent, the dependent cannot file a joint return with her spouse unless the only reason why is to get a refund for any taxes withheld, but there's no liability existing, right? What does that mean? Let's say, for example, I have a client where she has a Down syndrome child, and the Down syndrome child is married, and they're married to another Down syndrome child, but they're functional and they live on their own in an assisted living, but they're married, right? And but they have small little jobs, and they have their life in the assisted living, and they don't make more than the standard deduction. But an employer is required to take taxes out of everybody's check. So the reason why they're filing the tax return is to get a refund for all the taxes that their employer took out of their check. They didn't owe anything, but the money was taken out of their check because that's what an employer has to do. Citizen test. The dependent must be a citizen, a U.S. resident, or a resident of Canada or Mexico. Between 2018 and 2025, they may not claim a dependent tax credit unless the individual is a U.S. citizen or U.S. resident. Unless it's an adopted child that's not a citizen because they're not there, they haven't come here yet, okay? Sometimes it's a long process. So the relationship test, the residency, age, support, qualifying child, qualifying relative, that's a summary of everything, okay? This is the tax credit that we just talked about here, right? This was increased to $3,000 during COVID, but now it's gone. And it was also increased to $3,600 for any qualifying child under the age of 6, but this is all gone now. This $2,000 and this $500, if you make too much money, you won't get the $2,000 or the $500. So here's an example. That's the $500. So the $2,000 and the $500 begin to phase out when AGI reaches $400,000 or $200,000. $400 for married filing jointly, or $200 for, right? $400 or $200 for other taxpayers. And the credit is phased out by $50 for each $1,000 above the $400 or $200. Okay. Then there's a second layer. Anything over $439, it's completely phased out. It's gone. If you have 2 children, it's $479, and then there's other ones, right? So here's the example. I have 1 child or 1 dependent, 1 child, 1 dependent. Here I'm married filing jointly, so it's $400. I'm single, this is the $200. So for a child, I'm allowed a deduction for $2,000. If I have a dependent, it's $500. Those are my credits. Okay. For every $1,000 I go over the 400, which is like 401 is $1,000, my credit gets reduced by $50. My dependent credit of 500, because I'm over $1,000 more, it gets reduced by $50. So this is my credit, 1950 and 450 versus 2050. 19 for another $1,000, I lose another $50. Same idea. My credit is 2,000 or 500, but I'm single, so my limit's 200. So anything $1,000 or apart. If this is 1,050, it's gonna be 202. $50 is gone. $50 is gone. Another 50, another 50. And then after the 240, it's zero. After the 440 is zero, right? Because it gets phased out after 439. And then there's another calculation this is the calculation right there. Okay. The refundable portion of the child tax credit. When you do a child tax credit, it's giving you money back. So it's refundable to the extent of the lesser of $1,700 of the child tax credit for each child, or 15% of the taxpayer's earned income in excess of $2,500. So there's a refundable portion of the child tax credit, meaning that you can get the money versus just a reduction on your tax return. Okay, just understand that concept. So you can read that knowledge activity question and answer. Filing status and filing requirements. I've already kind of gone through that when I went through the tax return with you. The filing status, single, married filing jointly, married filing separately, but we're going to go through a little bit more detail of that. You must know what is your filing status to make sure that you're computing your taxable liability correctly. You need to know what your share deduction would be, whether you have to file a return or not, what your liability, meaning what you're going to owe. Do you have itemized deductions or credits that you can have that we did, right? So there's the 5 statuses: single, married filing jointly, married filing separately, surviving spouse, head of household, and the tax varies for that. So when we did chapter 1 and we went through the 0 to 11,600 for single, each of these, this is a different rating of levels. Married filing separately follows single. Surviving spouse follows married filing jointly, and head of household is a little bit different. So single. Unmarried or legally separated or divorced and does not qualify for head of household as of the last day of the year. A legally married same-sex couple is treated as married for federal tax purposes no matter where they live. But the states will be different. Married status is determined as of the last day of the year, except when a spouse dies during the year. Then the marital status is determined as of the date of death. Filing a joint return has a potential disadvantage: joint and several liability. So, for example, if I'm filing jointly and my spouse is the one who owes let's say I'm a stay-at-home mom and I don't have a job and I don't work, okay? And we file jointly, and my husband files a tax return, and we owe $2,000, and he says, I'm not paying it. I'm going to be liable for it because I'm filing jointly, okay? A spouse cannot switch to separate returns for the year in which the joint return has been filed. So you have to make sure that that's going to happen. Married filing separately, each of us would record our own income deductions and credits, et cetera, et cetera. Okay, so surviving spouse. This is when somebody, for 2 years following the death of one spouse, if the surviving spouse maintains a household for a dependent child. The child must be a son, stepson, daughter that qualifies as a dependent of the taxpayer. Okay, it just gives them a little extra money for 2 years after the loss of their spouse. Head of household, unmarried individuals who maintain a household for a dependent can use the head of household filing status. And then you have to follow these rules, okay? Assuming Aaliyah can be treated as single, not married, can Tara qualify Aaliyah for head of household? No, because she's not her child. Even though Tara can be claimed as her dependent, she can't be head of household because she doesn't meet the relationship test for a dependent child. Abandoned spouse rules. Now we know that her husband left her in March, I think. She can file head of household if she does not do a joint return, if she paid for more than half of the cost, which we know she did. That was one of the facts. The spouse did not live with her for the last 6 months of the year. He left in March, so he didn't. So this is good, right? This is good. This is good. The home was the principal residence of a taxpayer's son, daughter, stepson, foster care, blah, blah, for more than half the year, and then can be claimed as a dependent. We don't know if they can or they can't yet because we have to figure out about Paige and Tara if they can. Then she'd be head of household. Yes. Can she be an abandoned spouse? Yes, if she can claim Paige as a dependent, either as a qualifying child or as a qualifying relative. So Aaliyah can use head of household status. If not, her status is married, filing separately because they're married still. Okay. You must file a tax return if your income is equal to or exceeds the applicable standard deduction. Okay, if your gross income, you must file your tax return if your gross income is equal to or a greater than your standard deduction, right? The standard deduction to you, including the additional standard deductions, which if you're over 65 or blind, except for the case of dependents, the additional standard deduction for blindness is not taken into account. What does that mean? Let's say my dependent is a 30-year-old child that is not mentally stable, but lives with me. Sorry, let's say my dependent is my mother and she's 82 years old, which is over 65. So, but I don't have a lot of income and my income is less than the standard deduction. I will not take into consideration the additional standard deduction of being over 65 when I'm doing this test, okay? A dependent must file a return if she or he has any of the following: earned income only and gross income that's more than the total standard deduction, earned income only and gross income of more than $1,300 plus the additional standard deduction, or both earned and unearned, that's the 13 or plus 450. So I have this here. Okay. So you must file your return if your earned income only and gross income is more than the total standard deduction. Your unearned income and gross income of more than 1,300 plus any additional standard deduction. This is dependent, right? The dependent was 50-50. Right? 50-50 plus the 450. So here the wages are 4,800 plus unearned income the $49.50 is less than the standard deduction of $51.50. So should go only to file a refund. The earned is $4,800, $400, it's $5,200. It's greater than the standard deduction of $51.50. Should file a tax return, $51.50. Okay. Okay, so let's get to the next is the tax determination. So what is your tax rates, right? We did the tax table in the first chapter. I did it in that Excel file, and you can go look at the tax liability tables. There's a tax table method, which we did, and the tax rate schedule method. But go back to that. We did it in chapter 1. Okay. Taxes payable or refund due. Once you put all this information in and you get down to your taxable income, then you do the work that we did last in chapter 1, which was like from 0 to 11,600 is 10%, and from 11,601 to the next is 12%. You come up with your tax. So let's say my tax here is $5,000. And let's say my employer on my W-2, they withheld $4,000. Well, that means I have a liability of $1,000. My tax I had to pay was $5,000. My employer took out $4,000. So that means I owe $1,000. If my tax is calculated as $5,000, but my employer took out $6,000, then I don't owe $1,000. I have a refund of $1,000. So the tax return helps you to figure out what your employer should have taken out of your check versus what they did take out of your check to say, did you get a refund or do you have payments that you have to do? Okay, that's what this is about here. Okay, so you can read this, and this is using the schedule to figure out what your taxable amount's going to be. Okay, and there's another one, another knowledge check. The kiddie tax. The kiddie tax is the unearned income of a dependent child. So what is this about? This happened because a lot of very wealthy people were paying a lot of money for a lot of taxes because of their income that they earned. And what they started doing was they started opening up bank accounts for children, 2 years old, 4 years old, 5 years old, whatever, and throwing all that money into those accounts. Why? Because remember when we talked about the tax rates, 10, 12, up to 37, these clients were up at the 37% rate, right? And all their income above that amount was taxed at 37%. So they want to take some of that income off of their 37% and put it into their child's, and the child would be 10%, 12%, 15%. So for a family, they're moving money to get a lower tax rate. So there's a calculation that has to happen that if there's any unearned income of more than $2,600 for a child that's under 19, you have to do, the kiddie tax does not apply. But if it's over 2,600, then there's a calculation you have to do. Okay. Now, the kiddie tax does not apply if the child has earned income that exceeds half of his or her support. So if the child is under 19, has a job and earns money that's more than half their support, it doesn't look like it's like they could have put the money away and earned that money, right? This is more for children who don't have jobs and where they get this money and why there's money in their name, right? If the child is married and files a joint return, the kiddie tax does not apply if both parents are deceased. If both parents are deceased, it means the child inherited the money, and that is protected. So let's say unearned income, you take the unearned income, which is interest, dividends, bonds, whatever. You subtract out $1,300. You get a number. Then you subtract out the greater of $1,300 of the standard deduction or amount allowable of the itemized deductions directly connected with the production of the unearned income. What does that mean? Underneath your itemized deductions on your Schedule A. Oh, I'm in the wrong one. Other itemized deductions, right here. This is what they're talking about. Is there any allowable itemized deductions directly connected with the production of unearned income? So if I go here, okay, other miscellaneous deductions. One of those other miscellaneous deductions would be net investment income versus net investment expense. That's what they're talking about. So we'll make that number up. So you take your unearned income. Let's say it's 2,000. It's got to be over, like I said, $2,600. So let's say it's $3,000, right? $3,000. They have unearned income of $200. That's $3,200. The 3,000 plus the 450. Let me go back to where I was. Sorry. Oh, I'm doing the other one. Hold on. Well, it's first. Okay. So I'm going to put this in here so we can see it, right? All in one page. So you have your unearned income less $1,300 less $1,300 of the standard deduction and the amount of the deduction, itemized deduction, allowable itemized deduction. Equals the net unearned income. Okay, so let's say my unearned income is $2,700 less $1,300 the greater of $1,300 of the standard deduction or the amount of allowable itemized deductions, right? This is the greater of. Why am I not? Okay. And let's say that this is going to be the itemized deduction is usually smaller. It's usually smaller because it's net income minus net expenses. So let's just say it's $1,200. I'm going to make that up, right? Less the $1,200. So 2,700 minus 13 minus 12 is $200. Okay. That's the net unearned income. Okay. So now, what's the tax determination? If a child is subject to the kiddie tax, there are two options for computing the tax on the income. A separate return may be filed for the child. The parents may elect to report the child's income on their own return. So this is what the total unearned income is. Do this calculation. This is the net unearned income. This amount is going to either be a separate return for this income, or the parents put it on their return. Okay, so it's basically $200 of the $2,700 is going to be taxed. Okay, and then there's election to claim certain unearned income on a parent's return, so they can actually just elect to do that if they wanted to. Okay, and then other rules there. So there's a knowledge check for you there, another knowledge check, and then tax return filing. You can do it on the forms like I've been showing you. You can do an e-file approach. You need to find out when and where to file, depending on what's your city and state you're in. Let's go back to the big picture. One of the concerns for Aaliyah is her filing status. Is she going to be qualified as abandoned spouse? Is she titled to the head of household? If not, she's considered to be married filing separately, which is going to be detrimental to her because she gets less of a deduction. Moreover, to be an abandoned spouse, Aaliyah must be able to claim Paige as dependent. So to be a dependent, Paige must meet those requirements, but the only thing we don't know about is she under 19, or is she a full-time student? Well, we know she's not a full-time student because she says that she's looking for a college to get a good scholarship, and she's not disabled because she could be disabled. We don't know. They say it seems highly unlikely because she's a gymnast. But we also have the Paralympics, which are not disabled, because that's that word disabled is something to really know what the definition is. Because she's not a full-time student, is she under 19? If she is, she's a qualifying child. And then that will help her to be a head of household. All right, to be dependent, Paige must meet the requirements of a qualifying child. If she's not a qualifying child, is she a qualifying relative? The answer depends on the gross income test. How much did she make from her part-time job? Is she earning under the 50-50? As a result, if Paige can be claimed as dependent under either qualifying child or qualifying relative, Aaliyah could be an abandoned spouse entitled to head of household status. If not, she's married filing separately. Right? So now head of household will give her $20,800 for deduction versus married filing separately is $13,850. So it's really not fair, right? Tara can be claimed as Aaliyah's dependent because she's a member of the household. It does not matter that she died in February because she lived there for her whole year. Because Tara is her dependent, Aaliyah can claim the medical expenses. So we're repeating ourselves now, right? Does Tara qualify Aaliyah for head of household? No. Although she's a dependent, Tara does not meet the relationship test. What ifs? You can look at the what ifs on your own, okay? And the summary as well. Okay, so please make sure you do your homework. And these videos if you have any questions, please email me and I will do a separate, what do you call it? Zoom call with you if you want to. And remember that underneath in Blackboard, let me go to our class. Spring, fall, no, wrong class, sorry. Too many classes, I can't keep track. Underneath your course materials, here's where your Zoom recordings are. This is the PowerPoints, and this is where the Excel file is. So if you have any questions, make sure you go to your Cengage to do your homework. Let me know if you have any questions. I will go over anything you need.